You know, I attended NC State here in North Carolina, so me teaching a class at Wake Forest was something that I never actually thought I'd get a chance to do. So thanks, Bob, for inviting a wolf pack into your home here.
Thanks for saying yes. This is the other piece Kevin had. I'm sorry.
Unlike the folks that came before me, I'm really close to a lot of you guys' age. I'm 28 years old, so I've only been in the market for, you know, just a few 6 or 7 years. Graduated from NC State in 2001. I was a computer engineer major, and how many of you remember what was going on in 2001? It was definitely the wrong time to be in computers. So, you know, when I went into college, I remember if you were in computers, you were making $30, $40 an hour. When I came out of college, you were lucky to be able to get a job in computers. But I was fortunate, and I did work here at Algenon Consulting here in Winston-Salem for a little while as a network engineer before I was recruited by Citigroup Solomon Smith Barney as a wealth banker. And then I also worked at UBS Paine Webber as an asset manager. I basically managed assets for affluent investors. So in other words, in order for you to come into my office, you had to have $1 million for me to play with. And here I was, I'm a 23-year-old kid, and I'm managing all this money. And trust me, it's a ton of fun. Now, some of my clients, you know, I've got guys that were literally twice my age, and they come into my office, and they're signing over their $1 million check, and they're looking at me, and you can see the sweat coming off of their face because they're like, what is this kid going to do with my money? So I didn't lose too much money. In fact, I made some people some good money. And that sort of led me to Wharton Gladden Company. I am the managing director of Wharton Gladden Company. We are a real estate investment banking group. And in a sense, what we do is we work with developers, real estate investors, and even business owners who want to tap the capital markets in order to raise debt and or equity for commercial real estate. We also do that for apartments as well. When we actually started out in the market, we were whole loan traders. So what that means is we represented buyers and sellers of whole loans. So if a bank such as Kevin's wanted to unload some residential mortgage paper, they would come to a group like ours. We had relationships out in the market, and we would actually trade that paper for them. I've actually participated in probably a little over $1 billion in whole loan trades, and I've originated probably slightly over $100 million in multifamily and commercial real estate loans. So pretty busy to still be my age. We prepared this presentation to just try to give you an idea of how we use CMBS. CMBS is one of the major ways that we actually go to the permanent markets in order to fund some of our commercial real estate loans. And within this presentation, you'll learn a little bit about how CMBS loans are structured. You'll learn a little bit about how they're securitized. And then you'll also learn the definition of what is CMBS, what does that acronym mean, and why does it mean that. I'm going to try to get through the presentation, the actual PowerPoint, as quickly as I can, because I do want to leave some time afterwards, because I want to talk about what's going on in our market now and how that's affecting CMBS, because it was a lot of our investors that sort of caused some of the problems that you're seeing in the residential mortgage market now. So I want to try to explain some of that. And I also want to spend a few minutes and tell you guys about equity and how we raise equity for commercial real estate projects, because that's becoming a bigger need. If you're going to a guy like Kevin and you need to get a construction loan, you know, he's only going to fund maybe 70% of your funding. A lot of our developers have been used to getting 80, sometimes 85% leverage, so they're trying to figure out how do they cover that gap. And equity, raising equity is a good way to do that, but we'll do that at the end of the presentation. How do we?
I can drive. Let me drive. Just say go and I'll change it for you.
Okay.
All right.
Back in the early 80s, residential lenders were using a process called securitization in order to fund their mortgages. Basically what they would do, and if you recall from Beth's presentation, they originated several mortgages. They take those mortgages, they pooled them together, and then they sell that pool, that securitized pool, out in the secondary market. In the early 90s, you guys probably will definitely not remember this. You may want to look this up. Actually, in the late 80s, we had a savings and loan crisis, but in the early 90s, there was a company called the Resolution Trust Corporation that actually took over a lot of those failed banks. And when they inherited those commercial loans, they were trying to figure out, well, what do we do with them? How do we get rid of them? And they started using the same process that they were using in residential mortgage securitization, to do the same thing with commercial real estate loans. They started bundling them up and securitizing them and selling them in the open market. And it's really efficient because if you heard what Kevin said about how they use their money in order to do loans, they're using money from checking accounts and CDs and money market funds and all these different ways that banks use their money to loan out capital. Well, some of that capital that they generate, it's expensive. It's expensive to generate some of that capital. So residential mortgage securitization is an efficient way to actually make those loans and then get them off your books and get them sold out in the open market. And in other words, what you're doing is you're bringing in large institutional investors that have long-term capital and they want to hold those assets for a long period of time. This graph here just sort of shows the growth of CMBS over the last 10 years or so, since the early 90s. And also to just clarify, CMBS is an acronym for Commercial Mortgage-Backed Securities. Once those loans are originated and they're aggregated, they're then transformed into a mortgage-backed security. But this will just show some of the growth that we've seen over the 90s or the last 10 years in the CMBS market. And this is the last few years. In 2006, we had, in our industry probably originated around 160, 170 billion in commercial real estate loans. In 2006, we topped over 200 billion in commercial real estate loans. And in the past year, in 2007, we actually finished the year with about 230 billion in commercial real estate loans. So about 10 billion actually short of what we thought our estimate would be. We were actually estimating to be at about 240 billion. But a lot of what happened with the subprime mortgage crisis over the summer really dried our originations up, and of course we didn't hit that mark. Now, just to give you an idea of the impact that the residential subprime mortgage crisis has had in our market, we did 230 billion in 2007. This year we're only projected to do 100 billion. So we're actually going back to levels that were even prior to 2005. So that sort of gives you an idea of the massive impact that we've had in the CMBS market. This pie graph here just shows you back in the early 90s how much of the market CMBS actually had. You know, we only had about 3% of the total market. Commercial banks and insurance companies pretty much dominated the market. And GSEs, which are Fannie Mae and Freddie Mac, which you learned in Beth's presentation, Fannie Mae and Freddie Mac actually also, not only do they deal with single-family residences, but they also deal with apartments and what we call mixed-use properties, properties that would have an element of multifamily and retail mixed in together. And then you fast forward to today, and CMBS has taken over about a third of the pie. We're almost at about between 20 and 25% actually today, because I think these figures are from 2005. So we're at about 20 to 25% now. And you can see that insurance companies really reduced their portion of the pie. Now, the reason why they did that is because it became more efficient to just buy our CMBS bonds. You know, insurance companies were having to maintain very large origination platforms. They had processing departments, administrative groups, and they started to realize, well, hey, we can shut all that down, and all we have to do is just buy CMBS bonds out in the open market. So that's how CMBS really started to grow its share, and the insurance companies started to contract. Who wants to take a guess on how commercial banks exploded the way they did? Because they went from about 25% of the pie to about 43% of the pie. Just any wild guess out there? And Kevin actually talked a lot about it during his presentation.
Being a conduit for these mortgage-backed securities coming to market?
Yeah, using basically construction loans, and then obviously using our CMBS market in order to take those loans out. So by having an efficient CMBS market, these guys were able to make more construction loans because there was that exit strategy in place in order to take those construction loans out. So simply, you know, what is